Hello everyone, I hope you guys are doing well and studies going in full swing. In today's video, we will be discussing Index 113 on fair value measurement along with the important questions. This is not a very important topic, but nevertheless, we will try to invest maximum half an hour and try to get this out of our way so that we have that confidence with us, and at the same time, in case something comes, easy scoring. So first, when you look at fair value measurement, this is a standard which is required in order to ensure that entities use fair value consistently. There are 4 pillars behind this standard. First, it has to be an exit price, that is a price that I will get if I were to transfer an asset or kind of transfer a liability. So this is an exit price. So if there's a buying price and a selling price available, you will take the selling price. Second, in an appropriate market. Now, a particular product can be sold by an entity in various markets. However, which market should you take? Well, if the product has something called as a principal market is a market where there are highest number of buyers and sellers, the volume, etc. outperforms every other market of a similar type. So if your product has a principal market, then the price prevailing in the principal market should be taken. But if your product does not have a principal market, then you look at the most advantageous market. Most advantageous market will be the market which gives you the highest in-hand proceeds. That is after deducting transportation cost as well as transaction cost both. So you will look at the most advantageous market only if there is no principal market. If there is a principal market, the price in the principal market, whether higher or lower, will be the relevant price. Third, between market participants, that is, let us say there may be a plot of land which may have residential and commercial use. However, you want to use it for a residential purpose. Should the valuation necessarily happen based on a residential purpose? No, that is one of the possible uses. Another alternative use can be using it as a commercial land, commercial purpose. You don't want to use it, but can a market participant use it? The answer is yes. If yes, then the valuation will be based on what the market participant can do with the land. That is usually the higher and the highest and the best use based on the available possible uses. So you should consider the asset specific restrictions. If asset cannot be used for commercial purpose, you cannot review that. But if the asset can be used for commercial purpose, then merely because the entity cannot use it, like an entity specific restriction, should be ignored. That is the third thing. And fourth, in an orderly transaction on the valuation date. So when you look at an orderly transaction, it should be a transaction between unrelated parties without distress. So if these 4 criteria are met, that is, fair value is the exit price in the appropriate market between market participants in an orderly transaction, you have kind of reached the definition of fair value. So over here they've mentioned what is the appropriate market and then the price. Now the price, how do you calculate in a market? We will see using valuation methods, level 1, level 2, level 3 category inputs. However, if the question says calculate the fair value, should the fair value be after? So the available price after transportation cost, after transaction cost, what should it be? Well, the standard says that the price, that is a fair value, should be the available price minus the transportation cost. Should you also deduct the transaction cost? No. For determining fair value, no, because if you want to also deduct the transaction cost, it will become fair value less cost to sell. So if a standard wants you to deduct the transaction cost, then it will tell you to measure it at fair value less cost to sell, like a agriculture standard tells you. But if the standard does not want you to kind of deduct it, then the standard need not necessarily tell you to deduct the transaction cost. Now, what is a transaction cost? Something like brokerage, STT, stock exchange fees. These are all transaction cost, auctioneer fee. Transportation cost is a cost to transport the asset into the appropriate market. Transaction cost, let me get this clear, transaction cost should be deducted while calculating for most advantageous market. But once you determine what the most advantageous market is, for determining fair value, the transaction cost need not be deducted. Transportation cost has to be deducted both while assessing for the most advantageous market as well as for assessing for fair value. So this is something which is important, and the institute has also asked you questions on this. We will try a question from our Super 99 set, question number 1, which is similar to a past exam question as well, which will possibly give you some understanding. Let us review this. An asset is sold in 2 different active markets. A market where the transaction for asset takes place with sufficient frequency and volume to provide information on ongoing basis. This thing in the bracket is irrelevant. It is just defining what an active market means. An entity enters into a transaction in both the markets and can access the price in those markets for an asset at the measurement date. So there are two markets in which the transaction can happen. In market A, the price would be 26, transaction cost in that market is 3, and cost to transport the asset to the market is 2, which means the in-hand proceeds will be 26 minus 3 transaction minus 2 transportation, and hence this will be 21. Next, in market B, the price that would be received is 25, transaction cost is 1, and cost to transport the asset are 2. And as a result, this will be, let us say, 22 rupees. That is the net amount that would be received in the market is 22. Find the fair value of the asset. Now you are required to find the fair value if market A is the principal market. Now remember, if market A is the principal market, I don't even have to look at market B. I will directly look at market A. Now when I look at market A, in market A, you are asked to find the fair value. Is it 26? Is it 21? Well, for determining fair value, you will take the available price, that is 26, and from that subtract the transportation cost, that is 2, but not subtract the transaction cost, that is 3. And hence the fair value will be 24. Fair value if none of the markets is principal, in which case you will look at the net proceeds after deducting both transportation and transaction cost in market A. Let us say the net proceeds of A are 21, the net proceeds of B are 22, and hence B seems to be the most advantageous market, and hence the fair value would be the price of the product in B, that is the most advantageous market, which is going to be 25 minus 2, that is equal to 23. So this is something which will give you an understanding of, let us say, the fair values. 24 as we can see over here, and if there's no principal market, then ultimately you will find B as the most advantageous, and the fair value over here is 23. Okay, so this kind of takes care of the basic discussion over here. Next, you look at fair value of non-financial assets like a land or a cattle which have multiple uses. Now if they have multiple uses, ideally valuation should be done for those uses because market participants can use them. But there can be countless uses, for example, for an asset like land, and hence the standard says you don't have to exhaust all the uses. Even if you look at the uses which are commonly done by the asset in that locality, that should suffice. If there is no other alternative use, you can assume that the current use is the best use, but you will try to exhaust what a market participant in that area will consider while he or she buys the asset. Now, if let us say there is an asset which currently is used, let us say you are having a mill land in, let's say, Mumbai, and you are using it as a mill whose current fair value is 100. However, this is located in a posh locality where nearby high-end residential towers have been constructed. So, will a market participant possibly consider the use of this as a residential tower? Well, yes. So, a vacant plot of residential land in the nearby vicinity is coming at 150. Is that a valid alternative use? Yes. So, for this asset, you don't have to exhaust all the possible uses. Now, theoretically, you can dig a mine, you can do farming on that land. However, market participants in, let's say, Mumbai will probably not consider doing that. And as a result, over here, you will take which of the two is higher. We will say as a residential use. However, your asset is not ready for residential use. 150 is the value of the asset if it is available for residential use. Currently, your asset still has a mill land. If you are using it as a mill only, then 100 is the value. However, if you want to use it for residential purpose, you will have to first demolish the mill. There would be, let us say, a 30 rupees demolition cost, and hence 120 will be the value which should be taken. Why? Because if the asset is not ready for an alternative use, then the expenditure that you need to incur to get the asset ready for the alternative use should also be considered, and hence you will take this 120 over here. Highest and the best use, so you will take 120 for example. Okay. Next, you look at fair value hierarchy. When you look at fair value hierarchy, the valuation method, the golden rule of valuation is you should try to select a method which maximizes the use of observable inputs and minimizes the use of unobservable inputs. So observable inputs are those inputs which can be obtained from reliable third-party market sources, active markets, whereas unobservable inputs are usually your forecast. Like Gordon's formula is calculated, is using the valuation based on forecasts of growth, cost of equity, cash flows, etc. So that is the level 3 category valuation. However, if you are holding the shares of a company and those company shares are listed, the price of these listed shares, identical price that you will get of these listed shares, will be the price under the level 1 category or observable category. So you will try to select a valuation method which maximizes the use of observable inputs and minimizes the use of unobservable inputs. Now, how do you classify these inputs? Simplistically, level 1 category inputs are simplistically unadjusted prices of identical assets from an active market. So if I have 24 karat gold, market MCX gives me price of quoted price of 24 karat gold, that is a level 1 category price. Second, I have 23 karat purity gold, market gives me quoted price of 24 and 22 karat gold, in which case I can make certain adjustments to come at a price. This is called as an adjusted price. I am taking the quoted price of similar assets, making certain adjustments to come at the value of my asset. So this is the quoted market price of similar assets, which would require certain adjustments. So I can make certain adjustments to the 24 and the 22 karat gold price to arrive at the 23 karat gold price, level 2 category price. Or let's say I'm a company like Parle, which is unlisted, a comparable company like Britannia is listed. I can find the PE ratio of Britannia multiplied by the EPS of Parle, and then make certain adjustments, like Parle is unlisted, so illiquidity discount, etc., to arrive at the price. So I'm taking a comparable, a similar assets price and making certain adjustments to arrive at my price. So this will be treated as a level 2 category input. And last is a level 3 category input. So when you look at level 3 category, this is financial forecast, which means over here, if you do not have a direct market quote like a KE or a G in the Gordon's formula, financial forecast, if I do not have a direct quote of my company, like SpaceX of Elon Musk is not listed, it does not even have a comparable company, in which case I will have to use some other methods using forecast, in which case it is a level 3 category valuation. Generally, if possible, you will try to do the valuation using level 1. If not possible, then level 2, and if not possible, using level 3. If remember an asset has a quoted market price, then I don't need to go to the valuation methods. However, if the asset does not have a quoted market price, I may need to go to the valuation methods. The valuation methods over here may be, let us say, using market approach, that is finding a multiple like a PE ratio or EV by EBITDA and multiplying it by your EPS, or income approach where you forecast incomes or cash flows and discount it like the Gordon's formula, usually level 3. Market approach is usually level 2. An asset or a cost approach like NAV that you are using for mutual funds can be level 1, level 2, depending on how good the fair valuation of those individual assets are. So this generally gives you a broad understanding of Ind AS 113. There are a few questions which are there in your study material linked to valuation, where you kind of do present value of future cash flows, etc. Now, generally these are pure valuation questions. When you're doing FR, usually institute will probably test you on accounting and not necessarily on valuation, which it can test in AFM, but you can refer the study material as well as our notes where valuation is for a basic understanding. Generally, what institute does in such questions is it tries to find a value using the given data. If cash flows are given, it will discount it, find the enterprise value. If I want to find a value per share, from that I will subtract the value of debt and add, let us say, surplus assets or surplus cash that you have to come at the equity value, divided by the number of shares will give you the value per share. Sometimes what might happen is there may be certain discounts like a illiquidity discount, non-controlling discount, etc., which may be given. So if you are using a market approach, that is, you are using some other transactions or companies multiple and using it to value your company, you might say that the other company might be listed, or the other stake might be a controlling stake, your stake is not, and hence there may be certain discounts that may need to be done if the data in the question tells you that. So these are these 2-3 adjustments. If you are able to get that, like what is to be done with debt, subtract debt, add surplus land or surplus cash that you have, so you have the net debt position. If there are any discounts, you subtract the discounts, and by and large you should be sorted if such a question even lands up. Now there is this one particular question which came in the RTP of November 21, which is on fair valuation of decommissioning liability. Now this is a fairly tricky question, and hence we would want to try to do this separately for a better understanding. So on 1st January 2011, A assumes a decommissioning liability in a business combination. So if it is in a business combination, you will have to record it at fair value. The reporting entity is legally required to dismantle and remove an offshore platform at the end of the useful life, which is estimated to be 10 years. So there is an obligation after 10 years. The following information is relevant. Entity A was contractually allowed to transfer its decommissioning liability to a market participant. It concludes that the participant would use all of the following inputs, probability weighted, when estimating the price it would expect to receive. So we are trying to find out that if there is this site restoration liability which someone else had to do, then what would they consider? Well, that other person would say that I will have to employ laborers. So I'll have to pay labor cost, I'll have to pay for some machines, overhead cost. But even paying those costs, I am taking your headache. Why will I take your headache? I am spending my time, so I will need some profit margin. So, or I might appoint a contractor who might charge a profit margin. So even that may be considered. Again, if there's an item like loan, if I take over 100 rupees of your loan, I have to pay 100 rupees. There is no uncertainty. Decommissioning liability, if I take over your liability, there might be more than what I expected to be payment as well. So like in working capital CA inter, you create a buffer or a safety margin. You might also require safety margin. The cash flows may be given before inflation. You might have to do adjustment for inflation. A lot of adjustments may be done. So over here, sub point A, labor cost are developed based on current marketplace wages, adjusted for expectation of future wage increases required to hire contractors to dismantle and remove the offshore platforms. A assigns probability to a range of cash flows as follows. So labor cost may be 100 with a 25% chance, 125 with a 50% chance, and 175 with a 25% chance. If I do a probability based weighted average, your labor cost will approximately be 131.25. So over here, let us say 131.25 is your expected labor cost considering all possibilities. Now the problem over here is the way it is given, it is current marketplace wages. So it seems to be the wages today, adjusted for expectation of future wage increases, maybe like developers. Even if there is no inflation, we are expecting that developers, skilled developers, will be much more needed. So even if the inflation is zero, probably their wages will increase. So what is given over here, at least when you see the entire question, appears to be the current marketplace wages. Allocation of overhead cost assigned at 80%. So over here, overheads would be 80% of labor. So this is probably around 105 rupees, 80% of 131.25. Now third point, the compensation that a market participant would require for undertaking the activity. I am taking your burden, so I need some compensation, and assuming the risk associated with the obligation to dismantle and remove the asset. Such compensation includes both profit on labor and overhead cost, a profit markup. Remember, markup is on cost, margin is on selling price, of 20% is consistent with the rate that a market participant would require as compensation for undertaking. So basically, if I total both of this is around 236.25. So if I take 236.25 into, let us say 20%, that comes to around 47.25. So if I total this up, this comes to probably 283.5. So maybe a market participant would ask for 283.5. But the risk that the actual cash flows might differ from those expected, excluding inflation. A estimates that the amount of that premium to be 5% of the expected cash flows. So expected cash flows are 283. Till now we have not been given anything regarding inflation. So in any case, we are not considering anything separately. There will be a plus 5% safety margin into 5%. So this is around 14.18 approximately. 14.18, and hence if I total this, 297.68. So this seems to be 297.68. This is what a market participant should be expecting. Now comes a statement which is per se clear, but it may appear to be inconsistent with some other data in the question. The expected cash flows are real cash flows or cash flows in value of monetary value today. These are real cash flows. What do real cash flows mean? They are cash flows without considering the effect of inflation. Remember, monitor your nominal cash flows are after inflation, real cash flows are before inflation, and as a result whatever is given to you appears to be real cash flows. Now sometimes I do get a doubt from the students, and rightly so, that they say, sir, it is given that these are adjusted for expectation of future wage increases. Maybe. Now this is clearly conflicting information. At one place they are saying that the labor costs are adjusted for future workplace increases. At the other place they say that these are real cash flows. Institute has solved it using real cash flows because it is specifically loudly and clearly given to you. Sir, but that adjusted for future workplace increases, maybe there are increases other than inflation. Like coders, as we see, AI specialists that we see are likely to be in demand. So even if theoretically the inflation in India is 0%, still their wages will increase, not because of inflation but because of the skills being in, let us say, low supply and high demand. And probably that 100, 125, 175 has considered that, but not inflation. It is current marketplace wages, and at other place it is given that it is real cash flow. So we will solve it the way institute is doing, and as all of these numbers starting from 131, and every other number is just a percentage addition on that, but all of these numbers are treated to be before inflation numbers. Effect of inflation on estimated cost and profit. A assumes a rate of inflation of 4% over a 10-year period based on the available market data. Remember, data like inflation and interest rate is given in a percentage per annum, and hence unless otherwise given, it is percentage per annum. So if 297.68 is current marketplace wages and I have to adjust for inflation, I will say inflation is 4% per annum over 10 years, because at the beginning I've been told that the actual dismantling will happen after 10 years. So if I do 1.04 into 2, 3, 4, 5, 6, 7, 8. This comes 9, 10. This comes to around 1.4802, which means 1 rupee today becomes 1.48 after 10 years. So if I want to find the actual check that I will have to write after 4 years, I will say that this is 297.68 into 1.4802, which comes to around 440. So over here, 440 point, let us say 63. Now this is the amount that is usually given in an Ind AS 16 question when they tell you that an entity expects to incur 440.63 for dismantling after 10 years. This must have gone behind the scenes to arrive at that 440 number. Okay, so is that the fair value of site restoration? No, this is the estimated expense. I need to find the present value, but present value should be based on an appropriate discount rate. Now, a lot of times students say that what should be the discount rate? Should it just be the risk-free rate or inflation rate? Well, it depends on whether this asset or liability, in this case liability, is a risky asset or a risk-free. Like when you do CAPM for cost of equity, CAPM is minimum required rate of return for equity shares. Now equity shares are risky, and hence I will take RF, risk-free rate minimum, plus equity risk premium, RM plus RM minus RF into beta. So I take the risk-free rate plus the risk premium because equity instruments are risky. In a similar way, is this site restoration liability risky or is it risk-free? Sir, it appears to be risky, and hence the appropriate discount rate should not just consider the risk-free rate, which includes the effect of inflation. Remember, risk-free rate includes the effect of inflation, compensation for inflation, but also the risk premium. And hence, the time value of money is represented by risk-free rate, that is 5%. So should the discount rate merely be 5%? No. 5% is for a risk-free item. This is a risky item. And non-performance risk relating to the risk that entity A will not be able to fulfill the obligation, including A's risk, this is 3.5, which means the appropriate discounting factor considering the risk will be probably 8.5%, and hence if I take the discounting factor at 1.085, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, this will probably be, present value factor will be, let us say 0.4423. Therefore, A concludes that the assumptions used by market participants does not adjust the fair value for existence of any restrictions. You are required to find the fair value of asset retirement obligation. 440 point, let us say 63, expected to be paid after 10 years into 0.4423 in today's terms. So 440.63 into 0.4423, and this comes to, let us say, 194.9 something. So 194 0.9 approximately, this will be the value of your site restoration liability. So that should be it. I hope this session has been helpful. I'll see you soon with something else. Good luck, goodbye, and take care.